Welcome back to CryptoSmart Analyst. Today we're going to be talking about how to place your entries, how to know where to buy, where to sell, how to take your profit and not close too early, how to enter the market early. Basically, these are the things that Stic does for you. It tells you when to buy, when to sell, when to stay clear of the market. Those are things we're going to be talking about today, and how to use the Stic 2 version 2. The first thing you want to do is add the Stic 2 to your chart. So you can go to Stic. Right now, just type here Stic, STIC, bullish. It's the only Stic bullish you have on TradingView. So click on it, and it's going to be automatically added to your chart. So you have it. This is the effect on my chart right now. You can see the effect. We have the buy one, buy two. We have the entry and exit signals. The asset I'm trading right now is Solana, and I'm going to be analyzing Solana and how I've been using it to trade Solana for the past few days. What are things you want to look out for? If you look at the charts, you see BOS. BOS means break of structure. We have the BOS green, we have the BOS red. The break of structure above and the lower break of structure. That is what BOS stands for. Let me bring this forward. Visible, bring in front. Good. The other thing you're going to see on the chart is the up LQTY. That's the upward liquidity. So you have the upward liquidity. Then you have the down LQTY, which is downward liquidity. So that means that there's liquidity for uptrend, there's liquidity for downtrend. Downward liquidity means downward liquidity. Actually, just according to what it just said, downward liquidity means downward, upward liquidity means upward. It's possible for you to actually have upward and upward, then downward just beside it. It's possible. It's all about volume. You should know how volume plays out. And that features you want to look out for on the Stic on your charts is the sell, which is the buy one. We have buy one indicator whenever the market is going to flip into a buy zone. So it indicates a bullish momentum. That is, market price is going to go up. That you get a buy one doesn't mean that the market cannot flip and correct. When you get a buy one, and when you get any of the buy alerts, it hasn't been validated until the candle closes above the purple line. The purple line is the market trigger line, is the market flip trigger line. That is, the market is flipping bullish. If it closes above it, it means market is flipping bullish. If it crosses and closes, the candle cross and close below it, it means the market is flipping bearish. That's a trigger. It doesn't confirm that the market is closing bullish until it's just a trigger. So whenever you see it close above it, it's a trigger that is potentially going to close above. The market is going to go up. Like, look at what happened here. We have the candle closing above the market trigger line here, but the next candle reversed. You have to, when it closes, you need to wait for the next candle to close before you confirm that it's a direction. But if you want to come in early, once you see your buy, just buy it and follow it along. If you see it sell again, you can exit the market. So that's the way it works. Then we have buy two. Buy two also works in such a way that we have buy two, we have E buy two. There is buy two, there is E buy two. Let me see. How come I'm not seeing E buy two here? That's an error I think I'm going to fix. Yes. Wow, that's strange. It's fixed there. We have E by 2, yes. We have by 2. Let me just explain it from here. We have by 1, then we have by 2, we have sell 2, and E by sell 2. The E means extended. The E stands for extended. So we have by 2, that is, the market has flipped for a bullish change. Enter from here, you're holding. And you can see the market have a break of structure. That's the UFVG, means upward fair value gap. Then we have upward liquidity. You can see we have the upward liquidity here. Then we have the upward fair value gap. That is, the market is. We have a fair value gap here. There's a big liquidity here. This will only occur when institutional money, big money, actually flow into the market to pump the market. That's when you're going to see FVG. That is upward fair value gap. You're going to see IFVG. Let me delete this. You're going to see IFEG when the market reverses like this. When the same thing, just an inverse of, it is an inverse of upward FVG. That's why I call it IFVG, which stand for inverted fair value gap. That's a bearish signal. So when you have the buy two is also a bullish trend. You have buy 2, then you have E by 2. The market is getting extended. It's still in buy mode, but it's getting extended. This is a buy signal, this is a buy signal, this is also a buy signal. But once you get an E by 2 after a buy 2, that indicates that the market has a potential reversing either way. just hold your horses. And if you follow through, you can see the market end up giving us a protect your profit. This region is where the market is telling you take some profit, take your profit out of it. That's you need to protect the profit in this region. Take your profit, and if you can look at what happened 2 candles after, you get a sell signal. That's the sell 1 signal, then you get another sell 2 signal. And if you look at what happened afterward, you have market keep coming downtrend. And for it, the best signal to take whenever you're using Stic is the first signal. You want to ensure that you're taking the first signal, not any other one, just the first signal. If you miss the first signal, you want to probably just scalp. And if you miss the first signal, you want to now analyze the market. If the market is not showing a downward liquidity, or because you can, like what happened here, you can have a buy 2 signal and the next thing is a downward liquidity after it, indicating that your buy signal has been invalidated. The market is still going downtrend. And if you look at if you listen to what happened, you got a sell signal and you have inverted FEG, meaning that the market is actually going down. This inverted FEG will definitely come and mostly get filled, not all the time. They mostly get filled. Most of the time, they mostly get filled. The market is still going to come back to fill this high FEG at the top at 154. It might take time. It might be instant, it might take time, but whichever way, it's still going to happen. So these are things you want to look out for. Now it depends on the time frame you're trading on. It depends on how long you're trading and the time frame you're trading on. That is basically how they work. You have the buy, you have the buy. Then if you have an extended, another thing I want to point out is the fair value gap is a region. The fair value gap in this yellow one is also a fair value gap, but it's just a normal fair value gap. And note most time the normal fair value gap also gets filled. This get filled most of the time, because this one is actually sometimes the tool doesn't really label it well, but sometimes they still get filled. And if you look at what has happened over the year, if you look at what has happened over, if you probably switch to 1 hour time frame, you will see that this is actually a fair value gap. Let's draw a rectangle. I want to extend this fair value gap here. You can see that the fair value gap has been mitigated here. The market actually dumped, it has tested the fair value gap. Now, let me explain a bit something about fair value gap. Fair value gaps, you can read more about fair value gap, but just a quick explanation about fair value gap. It's divided into 3 sections here. We have the upper band, the middle band, and the lower band. The upper band is what we call the IOFED. That is the institutional money flow entry drill. Institutional flow entry drill. That's the upper band. The middle line is where we call the CE. That's the constituent encroachment. And the last one is what we call the FEG field. That is, the FEG has been fully filled. And most times, whenever the FEG gets fully filled, most times the market tends to continue downtrend. It doesn't happen like that in all cases. Like I said, trading is all about probability and no certainty. Probability. And most times when whenever the market dumps and test and fill the upper part or the upper band of the fair value gap, the market tends to reverse upward. If you want to place your entry, you know that you are longing, you want to place your buy around the upper region, between the middle and the upper region, just for it to take in exit. And you want to place a stop loss. For me right now, if I'm going to be placing this trade right now, I'm going to be, let's say when the market has extended uptrend, I'm going to be placing a long around here. My stop loss is going to be, my long is here. My stop loss is going to be below D here, because there's an order block here. There's another block here. Stop loss is below here. So my stop loss is going to be below the stop loss. And I want to, let's say I'm doing 2:2 here. 2:2. And I'm having my stop loss here. So I'm having my stop loss here. I place an entry here, I exit here. And one of the things I tend to do, my first target is actually around this. Like I said, we have, I didn't explain this. We have these 3 lines on the chart. On version 1, you will know that we have a yellow line, which we call the market flip line. But on the Stic version 2, Stic version 2 doesn't carry market flip line. You can see if I had version 1, this is version 1, you can see the yellow line, that's the market flip line. But it is not in Stic version 2. So in Stic version 2, we have the market trigger line, that is market flip trigger line. Then we have the market support and resistance line. That's the blue line. This support is the support and resistance. Sometimes it gets broken. If it's old, once it gets broken, it's breaking down below it. And the market will mostly come back to the test of support and resistance line. Now on my 15 minutes time frame, I want to, my resistance, I'm going to be targeting here as my entry 1, exit 1, and this one as my target 2, 138. because we have the what? The market, the bullish bearish market flip. The bullish, that's the green line. The green line stands for bullish bearish. Just added today, actually. They just added today, just the moving average. So we have the bullish bearish market flip. Once the market crosses and closes above this line, is an indication that the market is flipping to a bullish zone. If the market closes and crosses below this line, indication that the market is entering a bearish zone. You want to actually put that as your target or as your entry whenever you're trading. That's basically, I believe you understand how to place your entry now and how to place your exit using the stick tool. If there's any other question you need to do, there's one more thing I'm here to talk about. Okay, a minute in, nice. One of the things you want to do with the stick tool, which is one of the good features about the stick tool, is the alert system. TradingView gives you opportunity to be able to set your own alert. So you want to go to alerts, click on alerts, then you want to select stick. You want to select the indicator, yes, which is the indicator. Then you want to select the next option. So you have different configured alert I already put in. We have the bearish market flip trigger. We have the market, any bullish trail profit, any bearish take profit, any bullish take profit. We have a lot of them. Mostly I tend to use either any bullish buy. If I'm longing, I'm use any bullish buy or buy potential. So either of these two I tend to use buy potential, any bullish buy. Then if you're shorting, you want to use any bearish sell or sell potential. So those are, or you can also use the bullish ons and ensure that you apply risk management strategy. And I've always said, you should never place your entry at once. If you want to place an entry, let's say you want to risk $1,000, you should split that $1,000 into two or three, so that you can actually be able to take advantage of the market. You want to ensure that you apply proper risk management strategy. Let's say I want to place a buy alert right now for Solana on 15 minutes time frame. So you need to ensure that you already selected the time frame you want to be on. Select the time frame, then to place I want to place a buy potential. Yes, we place a buy potential for Solana, and as it has been designed. Then I want to use upper once per bar. That is, it's going to alert me instantly, even before the bar closes. It's going to alert me that there's a buy potential. Though it has already indicated it here anyway. So, like I said, for scalp traders, for day traders, you can use the buy to indicator. You can use the buy to alert. But if you're doing long term, let's say you want to trade for a higher time frame, then use the buy one, and that is what the buy one alert is. The any bullish buy. That is this one. You can use the any bullish buy, or you can use the bullish ont by one. That's by one. This by one bullish ont. That's bullish ont. Then if you want to take profit or you want to short, you can use the bearish ont sell one as your exit. But especially if you're buying, if you place a buy order, ensure that you're using any bullish take profit as your take profit. It is more profitable like that. It helps you not to get trapped, and also any take profit is a trail profit signal, and also a stop loss signal. That's the way it works. It works as a stop loss and also as a trail profit. Helps you to take profit earlier, sometimes more too early. But if you're using the any bullish buy can get you back into the market anytime, whenever you get a bullish signal. Okay, these are things you want to take advantage of. If you're doing long-term trade, you use the buy one and exit, take profit, exit. But if you are doing scalp trading, then you can use the buy two as a scalp trader. You can use the buy two signal and use your any take profit as your exit. If I enter here, the market is coming towards here 136 or max 138 or 138 to 137. From there I can start shorting. That's if the market did not reverse. Okay, so that is how to use the stick tool. I think I've covered everything I need to cover in terms of adding it, setting alerts. If you have any question, please don't forget to ask. Join our Telegram community to ask your question. We have a free stick tool group on Telegram that you can easily get to ask your questions. And like I said, the stick tool version 2 is basically built to be used by bots. We're going to be making available the APIs where you can get to connect for bot usage. This is how your alert will definitely come up. Whenever your alert comes on, you see it like this. That's the buy alert. This is the buy potential 3 alert. It's a buy potential alert for me to buy for Stic. So at long it, as you can see, you got your buy entry 1. This is the buy entry 1. Market is still bullish. Like I said, we are coming here 136, potentially 138, and we can exit. That's the blue line, the market support or resistance line. Once you hit the blue line, you want to take your profit, and potentially is going to hit the green line. But if it closes above the blue line, is an indication the market is flipping bullish. Then you can follow it through. That is it. If you have any question, please let me know, and Don't forget to trade smartly. See you next time.